Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York sugar and London sugar markets. I'll start with ice raw sugar in New York. Many things may have changed, since I last looked at the New York sugar contract, but one thing has been constant. The lower time of December 2020 to April 2021 bullish shift pitchfork, currently at 1749, is still the core of the bullish support. This lower time is coincident with the April 2021 today uptrend, and we have previously seen how it stopped the markets dropped dead back at the start of August, and more recently turned the market around on Monday of last week. We also saw in the recent action the resurgence, especially on a closing basis, of the support of the 50% Fibonacci line of the March to November 2021 move at 1768. Though the 50% absolute Fibonacci line for the 21st century at 1809, well, that has been less helpful or inventive. Now, I know there's a possibility of looking at the action from late July today as a possible sideways triangle, with the top trend line, which I have not drawn, in the 1850 to 1860 area, and the lower time acting as the lower trend line. Personally, I think that is a bit of a stretch, as is the idea of the August to September action being a possible double bottom. Nevertheless, even my considering these as ideas is a step in the bullish direction, which ties in what's happened today. See, over the last 2 weeks, the slowly declining medium moving average, currently 1853, has acted as bearish resistance, enough to be considered a trend line. And though we've punctured through it, and the slowly declining long moving average, currently 1872, prices have pulled back a bit. We're just literally above the medium moving average at the moment. Just below the medium moving average, not even just, but significant amount below the moving average. But that puncture is enough, I think, at the moment to be considered. Now, also, you need to look at is the long moving average. Just above that, we have the May to date downtrend, currently at 1880. I suspect this might be the real reason we've seen a pullback right now. What is interesting above all of this is that only in mid-August did we see a dead cross of the declining medium moving average push down through the declining long moving average. Now we are seeing all that dead cross being challenged, especially as the dead cross saw a lesser low in September compared to the one in August. Looking ahead and topside, we have another downtrend ahead. This time it's the April to date downtrend, currently at 1918. To be honest, I suspect that this downtrend may not be that effective. Instead, I'd look at the July high at 1959 and then the rising middle time of the same December 2020, April 2021 bullish shift pitchfork, currently at 1973. This is quite a way away, but it is worth considering. Ice Europe white sugar in London. This one is dominated by the changeover gap from 2 weeks ago on continuous charts. One can say a lot of things about what happened beforehand, but the changeover gap is really big. The action stretches from roughly the September 2016 high at 619 down to the 50% Fibonacci line of the July 2021 today action of 522.80. And the congestion seen in early 2017 at 517.80. The actual gap is from 541 even to 603.60. And there was one attempt midweek last week to try and start to fill it, which failed, and another today which seems a little bit more sure but has really failed as well. As it is, last week was an unsure action, and depending on which day, I would have looked at that action from a purely continuous daily chart basis, either a possible island type pattern. There is still time for this pattern not to follow through higher and become such an island pattern, but the further the market moves above the slowly rising long moving average, currently at 534.60, then the more likely we'll see a significant pullback higher. I know this sounds pretty obvious, but it sometimes helps to say these things out loud. Anyway, the immediate resistance above is the March 2017 high at 548.70 and the congestion associated with it, including the neckline of the August to December 2021 complex head and shoulders pattern, head and shoulders top pattern, currently at 550.30. This neckline has acted almost like the middle tine of a mildly bullish pitchfork as a dynamic support and resistance. We'll see how it fares on an approach from below. Now, looking at support below the congestion from early 2017 in the 517 area, 517.80 area, then we have limited support at 514 and 509.5. The latter seemingly stronger than the former. But then further, more limited support from the more recent end of 2021 lopsided diamond pattern between 490 even to 509.5. Overall, this is one that used to be easy to read as a daily chart, but has become a lot harder recently. Sugar white premium spread. There are 2 salient points to recognize here and 3 salient points to consider. They are all big picture items. The first is how the weekly key reversal down that constructed the recent high, which also reached up and completed target X1 at 191.5. This was the secondary and harder to reach target of the recent bullish ascending wedge pattern formed over June 2021 to April 2022. Well, this pattern was based around a reverse head and shoulders with a split head. Anyway, the point is how this reverse head and shoulders pattern reached up so high over target X1 but ended up forming a bearish pattern in the end. It was as if the market just wanted to get to that target, found nothing up there, carried on until it lost interest and reverted back down, completing its operation. The second is how the upper time, currently at 223 even, of the big old bullish Andrews pitchfork from 2019 to 2021, managed to capture the top of that market, admittedly after it had been breached, but still capture it and turn it back down within a week into a weekly key reversal down. That interestingly closed below the middle time, currently at 148.75, the very same bullish Andrews pitchfork. This makes me believe that this very large bullish Andrews pitchfork is still intact, a little damaged, and is mending itself. Now, 3 salient points to consider going forward. The first is that we have what seems like an ascending expanding wedge pattern formed since mid-April, currently 132.75 up to 235.25. It's not the best such pattern I've ever seen, but it's still there, and it comes with all the possibilities such a pattern can invoke. The second is a possible pattern in construction. We are set up for a possible monthly key reversal for September. So if on this coming Friday prices close either over 156 even or under 141 even, then we'd be on. However, right now the action looks like it may close in between, and thus give us the lesser outside week pattern. Interestingly, the previous monthly key reversal down in July did not work out so well, so there is a big dose of question marks with this pattern as to the follow-on or not. The third point is twofold, and it's to consider the support being given to this market by, firstly, the rising medium moving average, currently 140.25. Well, this moving average had not directly supported the market until July, but it had drifted higher in the shadows and came in when the second part of this support showed itself. The 250% Fibonacci lines also of the August 2021 to September 2022 move at 131.25 and the July 2019 to September 2022 move at 128.75. These two, much as this is the second part of the third point, these two, much as the medium moving average and working in conjunction with the medium moving average, have supported the market in recent attempts lower. They've held up the prices with the medium moving average. These are the salient points to consider going forward. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investors International Limited. And here comes the final bit.